Hey, listen, I do equity option trading as well as just equity trading alone. And a lot of people say to me, hey, AJ, why? Why do you focus on equity options and equities like this? And it was funny. I was on a YouTube radio show about 3 weeks ago. I was with 4 other traders, and we were going through kind of explaining working and things like this. And funny because we got to a point where we were saying, okay, what is your week looking like? What are you thinking that you're going to be doing this upcoming week? And the trader said, hey, I'm staying cash, I'm watching these signals come out, and it came to me, and I said, hey, I'm going to be doing this left and right. And the host said, that's because you're doing the option. And it's absolutely right. The flexibility and the ability with options allows me to trade. I'm going to get my crayon here. Hold on one second. I can trade markets that are going up, you know, for sure. I don't like that color. Give me one moment here while I switch it up on here and get something more visible. Yeah, I can trade markets when they're going up, but I can especially trade markets when they're going down. And for sure, I could be profiting from markets when they're going sideways, right? And that's because options allow me the flexibility to be able to do all that. In fact, options were designed for hedging, right? Market movers, the big traders out there that can actually move the markets with the amount that they do some trading, they have the hedges in place, and this is something that actually benefits. It gives us an insight into what these traders are thinking, right? Because we can actually see how much they're using options to hedge their trades. I'll explain that a little bit more in a second. But the other thing that we can do, by the way, right, and I'm showing you some what I call profit and loss diagrams. Each of our option strategies that we can use actually has a little bit of a fingerprint. And here I am. I'm showing the actual intrinsic value profit and loss diagram to represent a couple of different option strategies for these different directions. And these are of the intake, which means what the option is worth after it expires, right? So here I've got a long put. And by no means, thanks to the ability of things called synthetic equivalencies, by no means this is not the only strategy we can use if the market goes down. But it's probably the easiest one for people to understand. So say, for instance, we go with a long put if the market's going down, or a long call if the market's going up, or we could use a Condor type trade if it's going sideways. But guess what? If we don't have the confidence in what we're seeing to have the market be able to say, okay, it's going to go in one of these 3 directions. Say, for instance, you're pretty sure it's not going to go down, but you don't know whether it's going to go sideways or up. Hey, man, we got you covered. In that case, we've got something like a bull vertical spread that we can throw on it. And the vice versa is true as well. What if you know it's not going to go up, but then you're not sure about the other 2 directions? Well, then, you know, a good strategy to think about is a bear vertical spread. Or what if you're pretty sure it's not going to go sideways, but you don't know whether it's going to go up or down, like most consolidation patterns are? Well, then, you know, we can throw on a straddle or a strangle type trade. And by the way, some people say, man, with your option trading, gosh, AJ, there's so many different strategies that we may have to memorize. How do you do it all? Well, let me just put it out there for you that there is 4 strategies that if you know inside and out, all other, I think at this point it's like 27 other strategies are derived from knowing these 4. So I actually, because I like to keep things very simple, just focus on making sure I understand these 4, which is a call and a put, and a bull spread and a bear spread, specifically bull vertical spread and bear vertical spread. You know those 4, you'll pretty much be able to work into any other strategy that you're thinking about, okay? All right, so not only can I profit on directional move with options, remember I said they're ultimately flexible here, there's another component, right? And that is that they are wasting assets, which means they actually decay with value in time. Now, specifically, we talked about the intrinsic value. This is the extrinsic value, right? The extrinsic value decays with time at a faster rate as it gets closer to expiration. And some people say, well, why is it that it's not linear? The reason why it's not linear is it's back to human nature. Think about it, folks. When you know that you have a deadline for something, most of us don't do a little bit of that project every day until the deadline's there. What is human nature? Human nature tells us that a month before the project's due, we start to freak out. A week before the project's due, we really freak out. And the 3 days before, we pull all-nighters to get that project put together. Hope that makes sense. Because that's exactly what we see represented every month, even now on weekly options, with the expiration of its value. It's human nature, right? But we can actually capitalize that as option traders. So we could definitely trade the directional component like we showed on the previous slide, but we could also trade the fact that we know that time passes by. Last time I checked, a minute is a minute is a minute, which means a week from now, a minute is still going to be 60 seconds as it is now, right? So we can trade the fact that time's going to pass by on these options and that the value is going to waste away at an ever-increasing rate. Okay? And so I can actually work with options and I can actually short them, right? And when I short them, meaning selling them, I can then buy them back for a much lower price just because time passed by, if not letting them expire worthless. So there's the time component. There's also this other component that I talked about where we know people use them. In fact, the majority of their use is in hedging equity positions, right? And so what happens, right? There's a direct relationship. So options are actually a derivative, which is why they're called derivatives, of stocks, right? And the options, even though they're exchanged and traded on their own exchange and so forth, let me go ahead and get my marker out again. The component on the option trading, we can actually see when people, say for instance, they've got their stock, it's moving so nice, and then they get worried, maybe around earnings or maybe around some other component, or they get worried because there's a technical pattern forming, or there's some quantitatively determined levels of resistance or support found, right? They get worried that something unexpected might happen, so they start hedging by buying these options. So just in case there's a crazy move in the stock, their options will buffer that move for them. And what happens to the price of options because of this? Well, the price of options goes up. It's just like any insurance policy, right? It's funny, when I used to live in California, in order to buy earthquake insurance, it was very, very, very expensive. Why? Because everybody wants it. Probably because it's a necessary evil there. Here on the East Coast, where I'm currently at, you know, earthquake insurance, you could buy it for pennies until, of course, the earthquake that was just a couple of years ago that shook the Washington Monument, caused Lake Anna nuclear reactor to shut down naturally, thankfully, right? Now all of a sudden, earthquake insurance, before it wasn't even on some of the insurance, you had to, like, they had to go research it. Wow, we've never sold earthquake insurance here on the East Coast, but now it's up, right? So there's a demand for it. So when there's a demand for these hedging instruments like options, the price goes up. So that's where we can derive something called implied volatility. We could actually, you know, take the option price, factor out how many days it has to expire, factor out the underlying symbol price, and we'll actually see, we'll be left over with something called the implied volatility. And the implied volatility lets us see, based on how the traders are trading their options, what they actually believe is going to happen to the underlying symbol. Oh, wow. So we can trade that as well. In fact, Let me go back a slide. I got to watch my time. I actually had one of my students contact me today. I have open office hours. I don't mind answering the phone or the Skype at any time. And he said, how are you going to keep your conversation down to 45 minutes? You always go over with us. And he was kidding, but it was actually truthful. So I got to watch the clock here. The key here is, as you can see, that the time gets affected more aggressively as we approach expiration. The opposite is true with the volatility, right? As we're farther out in time from expiration, it turns out that the option price or option value is more affected by changes in that implied volatility than it is when we're closer to expiration. Let me actually bring over a spreadsheet. So this is a teaching tool that I used for my team on Monday the 2nd, and I took Facebook. Why did I pick Facebook out of all the tickers? Because on that day it was actually at about $75. I wanted to prove a point. Let me get rid of some of these chicken scratches here. Hold on. There we go. And so I drew some pictures by simply taking the real option prices right out of the options exchange, right out of the option chain. And so we plotted the actual option price. Now you'll see that we've got some purple and some blue here. The blue represent what's called intrinsic value, the value that's going to be left over. And something you need to know about these option creatures, of course, is that this intrinsic value is only a factor of two things. One is the underlying symbol price, and the other one is whether it's a call or a put. All right? It doesn't get affected by this time passing by, that curve that I showed you. It doesn't get affected by implied volatility changing. It simply gets affected by what's the underlying symbol price with respect to the strike price of the option and whether it's a call or a put. And so if I pull out that extrinsic value component, you see, and this is the same for an option, whether it expires, at the 3rd Friday of March or the 3rd Friday of next January, a leap, right? But then that other component, the purple component, if we pull it out, so if we pull this purple component out and separate it, it actually winds up looking like this, where the tip of this little pyramid is at the money, right? And then it goes off equally in both directions, right? This is the component, this extrinsic value, that profits off of time passing by. So time will pass by and this little pyramid will shrink, and implied volatility changes. So when there's a big demand for these options because they're afraid something's going to happen to the underlying symbol, and oftentimes it actually doesn't happen, but in preparation they might start hedging with these, and then when they're over, they don't need them anymore, they may get rid of them. You'll see this pyramid go up and down. And as the particular option you're looking at is farther away from being expired, then you'll see every little change in implied volatility has a greater effect than as this thing gets closer to expiration. And the opposite is true. When it's farther out in time, each day that goes by will only reduce this pyramid by a little bit, but then as you get closer and closer to expiration, each day affects this pyramid even further. So what's neat about this, coming back here, is you can see that these out-of-the-money options have all extrinsic value. These in-the-money options have almost all intrinsic value. In fact, if we normalize the data like I've done here, you can actually, depending on what you're trying to profit from, in other words, what pattern you're recognizing in the charts, whether it be a volatility graph, whether it be the price and volume chart or point and figure chart, whether you're just trading this off of time, you can pick the correct option to use based on what you're trying to optimize. If you're trying to do a purely directional trade, you might use one that's got only intrinsic value. If you're trying to do something based on time or implied volatility trades, like, for instance, the speaker before me was talking about profiting off of an earnings play, he might be using options that are only extrinsic value. So having this understanding of how the option actually operates lets us actually figure out what to do, because let me get rid of my teaching aid here, and I'll go on to another slide. I always talk about that there's two components of trading, and this doesn't, I've been analyzing traders for years, and I see this kind of theme run through everybody. It doesn't matter if you're a foreign exchange trader, if you're a stock trader, if you're a future trader. You distill it down and you learn that, hey, they do two pieces, right? They look for patterns. I call this pattern recognition, and then they look for pattern utilization. They somehow trade those patterns that they recognize, and they trade them for profits. And like I was telling you about the YouTube radio, I call it radio, but the YouTube event that I was part of, they were not able, because of the type of trading they do, to utilize all the patterns they were recognizing that week. And see, I like to be the option trader, because no matter what the market throws at me, whether it's a directional play sideways, up, down, whether it's just time passing by, whether it's a change in implied volatility, I like to profit. In fact, the way I was telling somebody the other day was, I'm like one of those kids, right, who, when they've got a board with the different shapes cut out, they look at the shape, and maybe there's a star shape, and then they go and they find the block that's the star shape, and they put it into the star and it falls through. Well, I do the same thing. I look at the markets and I say, okay, what shapes are it giving me today? And then I go over here to the pattern utilization, and I say, all right, now that I know what shape I've got, what do I have in my toolbox in order to profit from that? And instead of having the block fall through to the ground below, I have dollars fall through, right? That's the whole process that everybody who's a trader does. So for instance, when I'm doing my pattern recognition step, and by the way, it's so important, I feel, that you do it in two distinct separate steps. You don't try to jump to doing the pattern utilization, the trading part of this, until you've fully recognized the patterns you're seeing. You don't want to jump. You don't want to jump the gun. So like for instance, in the pattern recognition, after I've done a good broad market analysis, if I'm in the evening after the market's closed and I'm trying to figure out what I'm going to do the next day, I always start off with all of the underlying symbols I can. I use some sort of, in my case, I like to use a fundamentals filter to find those ones that are the best of the best, right? And I'll deposit them on something called a watch list. Now this is my pattern recognition methodology. Everybody's got a version of this. From the watch list, I'll do some sort of pattern analysis, whether it be something like flipping through naked charts, or whether I'll be using sort of automated algorithm tool that'll go through everything, but I'll figure out which ones are giving me high probabilities to look at without even pulling up charts. And from that, I'll create a pick list, and from that pick list, then I'll start looking at actual charts, graphs, and then I'll look for validation of those into something I call a hot list. Now the hot list for me, here's the definition. You might want to write this down. Are you ready? A hot list is a list of the underlying symbols I'm interested in that I would actually be ready to pull my wallet out and trade this thing the next day. Okay? I'm not going to be looking for things on my hot list that are days out, right? This is for tomorrow, right? Okay. So one of the key outputs of pattern recognition, and I can't emphasize this enough, is that not only do you have a pattern that you recognize, whether, again, it be in the price and volume chart, whether it be in the point and figure chart, whether it be in a volatility graph or what, but not only do you have that pattern recognized, but you also have assigned, through steps of validation, tests of validation, a confidence to that pattern. How confident are you that that pattern is what it is? And the reason I say that and why I emphasize that so much is that could be the answer to, one, whether or not you traded it or not, and number two, in the case of option trading, what strategy you might apply to it. So when you get finally and you've identified the pattern and you know what confidence you give to that pattern, and I always use a percentage. I've had other traders talk to me and they give it a scale of 1 to 10. How confident are you that what you're seeing is there? You'll then come and pick an option strategy. And I'll be honest, if you see, for instance, a trend continuation where you had a long-term trend and now you're testing that trend, it's pulled back, for instance, and now it's getting ready to go up. A lot of the symbols in the market today are doing exactly that. Depending on your confidence, you may say, okay, I'm going to trade that directionally. Depending on if it's a lower confidence, you might say, okay, I'm not sure if it's going to go up or sideways, so I'm going to use one of those vertical spreads instead. It's a different option strategy, and I can profit on either one of those. And it's not only a factor of whether the pattern I see is there, but also how confident I am in that pattern. So I can profit no matter what the market's throwing at me, right? By picking the correct option strategy, pre-selecting the correct options, working on my position sizing, and this is a balancing of risk. So you look at the risk that's going to be in your position. You never want to have too much risk applied to your portfolio, so it's just a mathematical exercise to go ahead and work backwards from what your trade risk is to what your portfolio risk should be, and that'll give you position sizing. And then you craft some follow-through rules to actually bring into your trading session. And once you're in the trading session, you're thinking about entry, position management, and finally exit. Okay? So no matter what you're trading, you know, I've specialized this for option trading, but it's always a matter, you always hear people talking about first pattern recognition and pattern utilization. All right, so I wanted to talk about sideways channeling securities tonight, because there is a handful. In fact, if you look at the broad market charts, namely the big three, the NASDAQ, the Dow, and the S&P 500, you'll notice that they took a little foray up. They could be setting up very well to bounce up, but there is some heavy overhead resistance. In fact, since about the middle of December, if not the beginning of December, we've been in a sideways choppy pattern. And a lot of our individual symbols underneath this are also in this same sideways pattern. And so I use 9 tests as part of my pattern recognition to identify if somebody's in there. Please write these down. I like to do a naked chart analysis, and this is where I flip through the charts with no indicators on them. I like to look at my Bollinger Bands and pay attention to the width of these Bollinger Bands. I like to count how many candlesticks, how many daily bars. Now, I don't pay attention to the wicks, but I do pay attention to the candle bodies. How many of them have been in the Bollinger Bands before they've broken out? That shows me how much we've been moving sideways. I like to look at my butterfly patterns, looking for butterfly bodies. Okay. So for instance, I might be looking for the 5, 10, and 20-day exponential moving averages, and this is just a good, easy way to see range contraction versus range expansion. Support and resistance. Man, I just had a topic, a conversation in our forum as part of our web portal on this exact, you know, what makes support and resistance, knowing that, you know, it's where people have seen patterns go to, and then they say to themselves, I'm going to set a limit trade there because I've seen it go there twice, and now it's going to, we believe it's going to hit that again and go back down. So they actually create a self-fulfilling prophecy. Fractal patterns. So I like to look at, you know, daily 6-month charts, weekly 2-year charts, monthly 10-year charts. See if the same pattern is appearing. Point and figure analysis. I'm a big fan of point and figure analysis. This is good for finding reversals. I like to count channel width versus average channel price. Again, channel width versus average channel price. How wide is the channel it's trading in versus what is the average price of that channel and that'll give me an idea on whether this thing will break or whether it's continuing to go sideways. And I like to look at company dividends. A stock that moves sideways sometimes is what traders consider an income-generating stock, and you'll notice that they give out dividends. So 9 tests in order to see if your stock is moving sideways channeling. In fact, let me pull open a browser. I'm already logged into the Trading Trainer web portal, and I'm going to jump over here to one of our screeners. I'm going to look for some sideways channeling stocks. This screener basically does a handful of those tests that I just put on there for you. And I'm going to come down here to these symbols that are channeling. We've got quite a few, like I mentioned, of tickers that are channeling. And again, I'm just going to pull up the one that we did the scholastic exercise on. This is Facebook. And I'll pull it up with some of those indicators on the chart so you can see just briefly what we were using in our pattern recognition in order to identify that. So I like to look at how compressed or how expanded the Bollinger Bands are to tell me if something's channeling or consolidating or to that effect. I like to count the candlestick bars since we've had a candlestick outside. I like to identify support and resistance. I like to look at these 5, 10, and 20-day exponential moving averages. If I'm getting too much of a range contraction, this kind of defeats the purpose of trading it sideways, because a lot of times that's that situation where we know if it's contracting, we know it's not going to stay sideways. It's going to go either up or down. We can't quite figure out which one. So Facebook is a good candidate. Let me drop some of these indicators and look at just a naked chart so you can really get an idea here. By the way, how many of you with the show of hands are following? Excellent. Excellent. How many with the show of hands are a little bit overwhelmed? Okay, good. Good, good, good. All right, I'm going to pull us back to, let's start off with a year-long chart here. And Facebook, by the way, is one of the ones that I am trading with sideways channeling strategies. I've been trading it with these sideways channeling strategies since about the middle of December. And as you can see here, when we look at a one-year chart, Facebook has definitely been trading between about $75 and maybe $81, right? If I do a line on close, maybe you can see it better. And so one of the option trading strategies we can employ here is a condor. Now, a condor is a trade, if you remember, that will profit if we know that it's going to be going sideways. But one of the things I'd like to share with you today, and I have about 5 more minutes, and then we're going to call it quits on this, but I can sum it up well. So a condor is a combination of a bull vertical spread, and up at the top here, a bear vertical spread, right? And the idea here with these spreads is that they will expire worthless after you've, if it's a credit spread, made some money up front, or if it's a debit spread, it'll expire. The extrinsic value will go worthless, and you'll wind up making the full difference of the spread. A vertical spread, of course, is where you buy one option and then sell a cheaper option, and therefore you make the difference. Okay? So by setting up these 2 vertical spreads on either side of the channel, and they both expire worthless, you kind of get double the money from these spreads, which could be, you know, depending on the spread and the proximity of it, oftentimes we're pulling in 10, 20, 25% per month if we're using our monthly options by setting up these condors. Okay? But here's where I want to give you a little bit of insight, where if you can realize the power of, I'm going to go to a 6-month chart. of what's actually going on here with your pattern recognition. So I've got, I actually pulled it down to 74 to 81 as my lines of support and resistance. And I'll use something, I'll use three main tools, and you might want to write this down. I'll throw my Fibonacci price retracement lines on. By the way, it was very interesting seeing the presentation a couple of presentations ago about the Fibonacci price retracement line usage. I'll use the Fibonacci price retracement line combined with a simple moving average crossing. And I can use the 3-day and the 5-day. That's what we call a lagging indicator, right? And so here's the rule. The rule is when you get a crossing and you move to another block on the Fibonacci price retracement lines, that is a good definition of a reversal. You have to have both of those criteria met. And the scoop is every time we get a reversal, whether it be up or down, we're going to place a vertical spread. It's going to be the timing of our vertical spread rather than placing the condor all at once. We're going to use what I call HalfCondors, and we're going to put them on and take them off every time we tie in bottom. And that's going to basically use the directional component, right? Up here, and we start to head down, our bare vertical spread is going to be less expensive. So we're going to profit on both a directional component and on the time passing by. Aha! So again, the rule of thumb to trade this is we look for a lagging indicator crossing, a moving average crossing. I like to use the 3 and the 5, or I might even go down to 30-minute charts, 30-minute bars. And on the 30-minute bars, instead of using 3 and 5, I'll use something like 39 and 65 bar simple moving averages. And when I get that crossing, I'll verify that I'm in a different Fibonacci price retracement band, and that will signal me to trigger another spread trade. I'll close one, I'll open another on either side, just bounce back and forth as we're going through the channel. And you can do this as an income generator all day and all night, finding tickers like Facebook. Right now, any of the energy sector seems to be in this pattern now. We're doing the same sort of trades on tickers like HES, H-E-S, and Devon Energy, ticker DVN, Chevron, ticker CVX. Even a ticker like General Dynamics, ticker GD, is demonstrating this pattern right here, right now. All right, the other thing that I'd like to throw at you is point and figure charts. So point and figure charts, if you're familiar with them, with the X's and the O's, their whole component is they increment one movement vertically for every time there's a reversal. And a lot of times you can define exactly what is a reversal, but I'll actually cross-check this type of chart with a point and figure chart. So I'm down to about 5 minutes. I definitely want to let you guys know. By the way, how many of you with the show of hands picked up something at all from tonight's presentation that I just showed you? Excellent. Excellent. Let me put your hands down. How many of you with the show of hands knew this already, but now you kind of know it in a different way that you can actually apply to your trading? Excellent. Excellent. And how many of you with the show of hands have enjoyed yourself so far? Fantastic. Hey, listen, we have a package that we put together. I don't want to go over too much, but we send you a DVD. We give you web portal access. We give you tons of monthly information. We actually are going to give all of this information for free here, including a strategy session with one of our one-on-one coaches to talk about where you are with your trading, where you'd like to be, whether you'd just like to be an investor who makes money or you'd actually like to get involved with the trading on a weekly or daily basis. And they'll, based on their experience, help you navigate what steps you need to take. I love that strategy session. And so all day and all night we're selling access to this for $147, just the price of the DVD. But I wanted to make sure you know that for you guys, we'd like to let you in for $97. We're running this special just for attendees of this webinar. And again, let me just pull open my browser and I'll show you. Here's the, actually let me show you over here. So it's $97 to get in with us here. And the website is go.tradingtrainer.com. And maybe Reed, you could put that into the chat box for us. It's go, HTTP, blah, 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 go.tradingtrainer.com. And let me show you what you get when you get there. I just want, and again, you can read all about it on your own. Give me 1 second here while I pull up the browser window. So if I go to the website, go.tradingtrainer.com. Did I do it? Can't even see for some reason. There we go. Let's move that. All right. Here we go. go.tradingtrainer.com. You'll come to a page which explains our guarantee, and you can put in your information, first name, last name, phone number, your address that we can ship the CD to. But what I want to make sure is that when you go to go.tradingtrainer.com, that when you look at the total here, that you see that we've applied a $50 discount. If not, please write this on your piece of paper. Make sure in the discount code area you have D, capital D as in Delta, S as in Sierra, C as in Charlie, the number 50. Those are all uppercase. There's no spaces, no hyphens. And you see that we gave you a $50 discount on the activation fee. And please read through this, make sure you understand it. We'd love to have you part of this because especially we do a lesson every Monday night and we talk about what's coming up for the upcoming trading for the week, and we make sure we're refreshed on all the strategies we need to have top of mind. And on top of that, you get access to all the different tools that we use and the charting we use and all of that good stuff. So I urge you to be part of this. But other than that, I hope you, and I definitely want to thank Reed for having all of us. I learned a ton today. By the way, if you have any questions whatsoever, I answer my own email at aj@tradingtrainer. Make sure you spell that right. TradingTrainer.com. Or feel free to give me a call, 970-266-8146, and I'm actually at extension 81. All right, and that's where we'll kind of leave it.